Welcome back to CMG Forex Forex Lesson. This is a masterclass for mastering your candlestick patterns. We have done a number of episodes, and hopefully, this will be our last episode for the intermediate class on candlestick patterns. So we started in the recent video, and that was part 1. So this will be part 2 for money management rules. This is an introduction to risk management, right? So this is part 2. So we started with that, and then we go to some examples. So we are going to look at some brief calculations, right? So it's simple. It doesn't need much of a calculation or mathematics at all. It's just some logic that we have to do. So we are looking at some case study. The case study is so just imagine you take 10 trades with risk of what? 3:1 risk to reward ratio on each single trade. I mean, when you win, you get $600. And when the market goes against you, you lose for $300. So if you are using 3:1, it means that you are risking what? 1 to get 3 of that. So let's assume that the money that you want to lose in terms of dollar, whatever the risk ratio, the numbers here, the 3:1 is a ratio, right? It doesn't mean the money, but it's a ratio that you can use to actually calculate the money that you want to risk. So if you are using 3:1, it means that if your SL, let's say SL amounting in terms of dollar to be $200, it means that when you win a trade, you are going to multiply that figure by what? By 3, which will give you 600, right? That's a simple calculation that we are doing here. You are risking 1 to get 3. You are risking 200 to get what? 3 times of that money. So that is as simple as that. So let's say your entry around this point, right? Your SL around this point. That would be in terms of what? Buy. And your TP is around this place. So your TP will be what? 3. And then your loss will be 1. So it means that if you lose, you are losing only $200. But if you gain, you are what? Winning 3 times that amount of money. So that is as simple as that. So let's see another example. Let's suppose you lost what? 7 trades, right? You are taking 10 trades, right? It's just a simple calculation. You are taking 10 trades, and what? You lost 7 trades, right? And you won 3 trades. Let's do the math to know if you are a winner or a loser, right? Let's do that this calculation. So 7 losing trades will cost you what? $1,400. If you get a calculation, what it means that 1 loss is what? Amounting 200. 1 loss of trade is amounting 200. So if you lost 7, it means what? You are just multiplying that figure, that amount by this figure, which is what? 1,400. 1,400, right? So in terms of what? Losing trades. And when you are winning, today winning trades will make you what? $1,800. So it means that if you are winning, your winning is what? 3. What is it? If you are winning, that's 1 winning with what? 600, right? 1 winning is 600. Let me wipe this out. In terms of winning, if you win 1 trade, you are gaining what? 600. If you remember, it was stated here, right? It was stated here, 600. If you win, you are getting 600 per a trade, because your risk to reward ratio for a single trade, a trade is what? Is 600. If you are losing, it's what? 200, because your risk to reward ratio is 3:1. So that is why it's 600 per a trade. So now, if you want what? 3 of that, 3 of the trades, right? That would be what? 600 times 3. That would be 1,000. 800, right? So if you look at this calculation one, even though you lost a number of trades, the number of trades that you lost was actually 7, right? And you lost what? Calculating those 7 trades is what? 1,400. Even though there are 7, your losing is very high. Yet you won what? Only 3 trades, and that you are gaining what? 800. So you realize that even with small winning trades, you are still gaining more than what you lost with a high number of trades. So look at this strategy. It's very important. This is why you have to what? Take your risk management into consideration. You should look at that very well. This is just an introduction. It's as easy as that. You'll be looking further into it more in the advanced series. Now, entry and exit strategy, right? Don't try to be smarter than the rest of the traders. Keep it simple. You know what you are looking for. When you identify an engulfing bar pattern and you think all conditions are in place to execute your trade, just do that. Take an order immediately after the price action signal forms. Put your stop loss below the candlestick pattern. Look simply at the chart to find the next support or resistance level. This is going to be your profit target. We have looked at this already. Where to put your SL, your TP, and all that. It's as simple as that. So in this ranging market, the market is what? Ranging. If you want to buy, you could buy here, right? You could actually buy here at this level. Put your SL just here, and your TP could actually be here, right? The TP could be here. In the same way, if you wanted to sell here, you put here, you saw this candlestick pattern. You put your price just maybe here, right? Your SL could also be here, this line, and your TP could be here, right? It's as simple as that. So with proper risk management, when you set your positive stop and your target, don't look back. Let the market tell you if you are wrong or right. This will help you trade successfully out of your emotions. Now, this is a very important point raised here. Usually when you put our SL and TPs and the market is moving, at times out of fear, we are forced to what? Push our SLs further away, thinking the market will get to some point and then retrace back and go into a TP. But many times pushing your SLs away will end in what? In jeopardy. You will lose more money. So when you set your SL and your TP, you should leave the market to play that way, because before you enter the trade, you actually did what? Your calculations, right? So why the fear, right? Why are you trying to drag things away? Because in dragging your SLs away, you are what? Incurring more expenses, more loss. In case the market or the direction, the price does not move upward or in the opposite, in the direction that you actually want. So just leave it as it is, because before you enter the trade, that is why you did technical analysis. You did that before actually entering a trade. So allow the market to do it, so that at least if you win or lose, you are still learning what's the market, right? So allow the market to play and then see where it ends. So in order to stay away from this, then you should what? Put in proper risk management technique before you enter a trade. So this is as simple as that. Now, if the market goes against you, you will not feel good. It is normal. Losing money can be emotionally painful. It is a human nature, right? Nobody wants to lose, especially when it is about money. In the trading environment, you have to think differently and accept the fact that losing is part of the game, right? It's one of the things that many traders, especially amateurs or intermediate students like you, fail to accept, right? You will lose some trades and you gain some trades. But the point is, you have the power to make your management at the risk management level, right? So this is what you have to do. Make sure you are okay with the amounts that you will lose in case the market doesn't move in a direction, right? You have to do that until you are able to do your risk management, do proper calculation. I don't recommend that you enter into any trade. It's as simple as that. Now, studies have shown that successful traders don't risk more than 2% of their equity on each single trade. So what it means is that anytime you enter a trade, per single trade, a trade that you enter, make sure that you are not losing more than 2% of your capital, right? Your risk should not be more than 2%. But in my case, the book is stating what 2. But in my case, I use tight, proper risk management strategy skill. So I put mine to 1%. I don't even lose more than 1% of that. I don't risk more than 1% of the trade, right? For instance, if your trading capital is $1,000, right? 1% of $1,000, I think, will be 10 or something. Or I think it will be 100. Let me check a minute. 1% of 1%. 1% of 1,000 is it's actually $10, right? So 1% of 1,000 is what? $10. So I don't risk more than what? More than $10 in case my capital is $1,000. So that is the percentage is what? Is a universal thing. So always know how to do your calculation before you enter into a trade. So after knowing how much you want to lose in terms of the amount, then you can put in what is called your lot and then the contract size or whatever, right? You also be looking at that. So that is it. Don't lose more than 1% of your capital in a single trade, right? Then for me again, my daily risk to reward ratio is what? It's one is what? 3:1, right? So it means that the whole day I'm not going to lose more than in fact mine is 3 rather. It's 6 is what? 3. So that's what it means. So it means that if a day I'm able to, if trade does not go well, right? If trade does not go well, I'm coming. Oh. 6:3, right? So what it means is that in the whole day, I'm ready to work, risk 3% of my trading capital, and then if I win 6%, I've closed for the day. So that is the calculation, right? Per that trading account. So that is it. If I lose 3% of the capital in a day, I don't take any other trades again. I don't take trades again, right? Then I close for the day. Then I wait for the next day. You should be able to do this. You should train yourself. You should be disciplined. This profession also needs discipline. Besides the fact that you may have the skills to trade and be able to adjust your risk management, you should be able to discipline yourself, right? So the moment you make the 6%, please close. There are times that you will make this amount of money, 6%, and you still want to make extra. That would be the greedy aspect of you, right? If you are greedy, you are too fear. You fear too much. You are afraid, right? You can't make it in this industry, right? So be disciplined. Plan well. Have your trading plan, your trading strategy in place. If you hit the target for the day, you close. Then you find yourself other things to do. You can be doing work. Find some hobbies to do. That would prevent you from attempting to take further trades. And many a time, if you hit your target for the day and you try to take extra trade, you will lose. in the end. That's what happens most of the times. You can ask your colleagues, right? Your senior colleagues, you can ask them. It happens many a time. So that's what you have to take note of. Now, if you are a beginner, don't risk more than 1%. Oh, thank God. Something is here. I didn't even see it. I was just saying, because I have learned already and I'm practicing that. You see, so he said this, but if you're a beginner, don't risk more than 1%. It's even saying more, not more than, right? Don't risk more than 1%. Don't risk money you can't afford on a single trade, even if the engulfing bar pattern you identify indicates a higher probability setup. There's another factor. Many a time, we are too convinced, right? We are too convinced that we take the uncalculated risk, right? We are too confident. In this profession, you can't be too confident, and you can't be afraid too much, right? You should just have, you should put your emotions in check, and this is very important. Now, no matter how smart you are, you have to think always in terms of probabilities. Bear in mind that you can experience these certain traits, and if you risk too much money, you will not survive longer, right? We have something called losing streak, right? Losing streak. You can be losing continuously, consecutively. A whole week, you will lose all your trade. A whole day, you can lose all your trade. In fact, a whole month, you can lose all your trade. Or better still, you can be in loss. And this can be very traumatic on you and have some drastic impact on your emotions. And many a time, it can even affect your trading strategy, your trading styles, your knowledge, even affecting your what? Your skills, your confidence in this profession. And when this thing happens, you are doomed. You can't come back. Even coming back will be very difficult, right? So just from the onset, as an amateur, as an intermediate trader, please learn these things in sequential order. Be patient. Take them bit by bit. I know many a time from outside this profession, before you even come, there are a lot of noise on the social media from friends, colleagues, that there are a lot of monies in this profession, right? So many a time before you even start this profession, we have this gambling spirit in us, impatience, greediness, avarice. Too much of this can rather be detrimental to us than being beneficial to us. So please put this thing in check. It's very important. Now, the inside bar candlestick pattern, right? So, don't worry, let's continue with this. The inside bar candlestick pattern is one of the most powerful chart setup that professional traders look at. However, most traders fail to trade it successfully. Lack of skills and knowledge and poor education are the major reasons why most price action traders don't make money trading this Japanese candlestick. What is inside bar pattern? You know this already, right? You know this already, so I'm not going to waste time about that. We are just going to look at that, how they are traded, right? So we have this to be the bullish inside bar. The inside bar is also called the harami. So this is the bullish harami or the inside bar harami. The second is fully engulfed by the first. So that is it. So, and then when we see this, and this is the bearish one, the bearish type, right? The bigger one engulfs with the second one, and the second one is usually a bearish candle, right? The first one is the bigger one called the mother, and then the smaller one, the second one is called the baby. So when this bearish is found at the top of a resistance or at the end of an uptrend, the reversal happens often. So that is it. Now, the illustration above shows inside bars at tops and bottoms. As you can see, the second small bar is completely contained by the first one, which is the opposite of the engulfing bar pattern, right? So we are not going to waste time reading this. We are just going to look at the formation behind that, right? The inside bar formation indicates a period of consolidation. In case of a bullish trend, it reflects that the bulls are not buying any further on the second day. It is represented by a small black candle on the second day after a strong uptrend. In case of a bearish trend, it means that sellers are not in control of the market anymore. It is reflected by a small white body or the green-white body after a strong downtrend. Your understanding of the psychology behind this pattern will help you better identify major turning points in the markets and time correctly your entry and exit. So how to trade the inside bar candlestick patterns, right? So the inside bar can be traded successfully in trending markets, particularly if the market is what? Is moving strongly. Because the formation of this price pattern provides you with great opportunity to join this big move. No problem. This strategy is very simple. You have to identify a strong trend and wait for the what? The formation of the inside bar pattern in line with the direction of the market. In fact, the formation of this pattern indicates that the market pauses before making its next move. This will allow you to enter the market in the right time, and make big move profits. So example of that. So this is what? A bearish harami, right? The color does not really matter, right? Even though it can be a bullish one, but here, when it is formed, I think we learned about that. If you have forgotten about the harami, you can look at that. The harami has a time that when it is formed in the direction of the market, that movement will continue, and then when it's formed at the end, the direction will be what? Opposite, right? So that is it. So this is what fully engulfed. This is what, if you have forgotten about that, please go there. We don't have time to do the revision here, right? So in this direction, we have a general what? Downtrend, right? A general downtrend, right? So when we see this forming, this is a harami, there's more hope that the market is going to continue in that direction, because the formation happened during a downtrend. So if it happened during a downtrend, the movement will continue. So that's what it means. But if only it's formed at the end, then the reverse of the movement will happen. So that is what you have to get from that. So this forms, you can actually enter from here. This also forms, you can enter from here. Below it, after forming, this also forms, you can enter below it, right? So in that order. We are not going to read about that. Now, this is another one. If it forms during an uptrend, this was the recent one was during a downtrend. So when it happens during the downtrend, the trend will continue in that direction, right? But when it happens at the end of an uptrend or a downtrend, then the reverse of the movement will happen. That's what I want to draw your attention to. It's very keen. You have to be very keen on this. This is very important. Now, this is an uptrend, right? And this formed what? During an uptrend. This also formed during an uptrend. This formed during an uptrend. During an uptrend, and then during an uptrend. It means that when you buy, you are going to what? Make it, right? When you buy, you are going to make it. You buy, you are going to make it. Because the formation of these candlestick patterns formed during what? An uptrend, but not at the end of the uptrend. So that is it. We are still not going to read this. How to do the inside bar breakout with support and resistance. So let's see. So I want to explain it in this way without reading. The reading is too much. So this is what? A downtrend. General what? Downtrend, right? So this downtrend, and then we have what? If it is downtrend, it means that this line will actually be our support. When prices cross over, it becomes what? Our resistance. That's what it means. So when prices got here, the resistance level, it broke it. Now when it broke it, a candlestick actually formed, right? This is a harami, right? But the point is, this harami formed during what? The downtrend. So if it's formed during the downtrend, then the trend is what? Has a high probability of continuing in that direction. So that is what it means. So after this candlestick forming, you can actually enter from here. That's the entry point. And then the SL can be around this place. The TP can be around this place. Then you are good to go. It's as simple as that. I'm not going to waste time reading. I think now you have the idea of whatever we are talking about. So that is why it's important you have to watch the videos from the beginning. So this is what? An uptrend, a general uptrend, even though from the onset there was what? A consolidating market. But when it goes here, if price started from beneath, so it means that this line is what? Our resistance. So when it breaks out, then it becomes what? Our support. But where it actually broke on that line was what? There was this candlestick forming, right? A pattern forming. And this happened during an uptrend. This pattern formed during an uptrend. So if it's formed during an uptrend, then we can what? We can buy. Entry can be here. Your stop loss can be here. And then you enter, a TP can be here. Or in fact here, right? So that is the harami for you. Now, tips on trading the inside bar price action setups. Trade bigger time frames, right? Trade bigger time frames. It's very important. I'm not against trading lower time frames. You can trade this setup on 5 minute setup, 5 minutes time frame, using other technical indicators to filter your signals and take just high probability setups, right? Now, but you have to be an experienced trader. If you're a beginner, I recommend you stick with trading with this signal in bigger time frames, such as the daily and the 4-hour time frame. I usually trade the 1 hour, but I do my top-down analysis from the daily, 4-hour, and then to the 1 hour. But before the week starts, I do my analysis on Sunday, looking at what? The weekly time frame, right? So that is it. Trading this setup on lower time frame will increase your chance to overtrade. Trading this setup on lower time frame will increase your chance to overtrade the market and take low probability price action signal. And this is the quickest way to blow up your account, right? It means that if you trade shorter time frame, like the term we call scalping, if you're an amateur, scalping is not recommended for you. It means that you are trading on shorter time frames. You enter the market within 1 hour, 5 minutes, you are out. And that is not recommended for you. If you focus on just bigger time frames, this will allow you to set and forget your trading instead of being emotionally controlled by the market. You just have to look at the bigger time frames, allow the market to actually play out. Don't force it. Don't be moving SL up and down, TPs there. Don't do that. And then 2, trade the dominant trend, right? You trade the strong move, the strong trend. That's what you have to do. You should start trading inside bars in line with the direction of the market, especially in a strong bullish or bearish trend. Don't try to trade it against the trend if you are a newbie. Don't do counter trading, right? You buy when the market is generally moving up, and then you sell when it's generally moving down. That's what you have to do. Trade only from key levels. Remember that not all inside bars are worth your hard-earned money. There are specific locations where this setup works great. So make sure that your signal is located in key level in the market, right? So make sure your trades are usually or mostly taken at these levels, resistance and support level. Don't be trading in the midway. Don't do that. If you do that, you are going to lose your money. The 4th thing is find different factors of confluence. right? Don't only base on the candlestick patterns and then the resistance, whatever. There are other factors that you can take into play. It means that don't use one factor to decide what enter the trade. Use a number of factors. At most 2, in fact, at most 3 is okay, and at least 2 is okay. It depends for a newbie. As you progress, you might want to add to your factors of confluence. I think 4 is okay. 4 is enough. So let's see. Now, trading with confluence means combining different signals to make the best trading decision. To trade this concept, to trade using this concept, you need to look for a point in the market where 2 or more levels are coming together and wait for an obvious signal to form, right? This trading method will give you confidence in the trading approach, and it will allow you to avoid over trading, right? So that's what you have to do. If you do this, you will avoid over trading. It means that you're only waiting for the right time to enter, not when you feel like you have to trade or you want to trade. You can't make it in this profession by what? Doing things impossibly. You don't have to do that. So, how to trade a false breakout with the inside bar candlestick pattern? Have you ever placed an order with confidence thinking that the market is going to go up, but price hints your stop loss before it starts turning out to your predicted direction? It happens many a time. Sometimes the direction that you want the market to move, the market will not move that sense. It will move opposite initially. That the moment it takes you out, then it starts moving in the direction that you anticipated earlier. By then you are out. And this can be very daunting, discouraging, and frustrating. So that's what you're talking about. So that's what you have to be prepared. Know the amount of money that you are ready to risk in case the market does not move in your direction. That's what it means. Banks and financial institutions know how we trade the market. You see, that's very, very, very bad. Very, very, very disappointing. That the institutionals and the banks, they know where we put our SS and TP. You see. So you see how tedious this profession is. So you have to be serious. You should be mentally side before entering into this profession. They know how we think and where we put our stop losses and profit targets. This is the reason why they could easily take money from us. Most of the famous strategies that big players use to take money from novice traders is called stop loss hunting strategy. So they come to take it out. After taking it out, then they move in our direction. That is what's called stop loss hunting. This strategy consists of driving prices to a certain level where there are massive stop loss orders. And the purpose is to create liquidity, right? Because without liquidity, the market will not move, right? So I think we will explain this later. What is liquidity, right? Where they make things very succulent, right? So they get to that point, and then it gives them the momentum to move up or down strongly. That is it. Once stop loss are hands, the market goes strong in the predicted direction. Like I said, the interaction between big participants and novice traders create repetitive patterns in the market. One of the most important candlestick patterns that illustrates how big financial institutions manipulate the market is the inside bar false breakout pattern. So if you're able to master this, it's very good. You make it. Your understanding of this repetitive setup and the ability to detect it on your charts will help you better exploit it to make money instead of being a victim of market makers and bank manipulations. This price action signal is formed when price breaks out from the inside bar pattern and then quickly reverses to close within the range of the market of the mother bar. So let's look at what it is. See, this is what happens. This is an inside bar, right? This is the bigger one, and then this is a smaller one. So when this happens, you think this is a bullish pyramid. Hence, the market is supposed to go up. Then the next candle comes in, it will initially pretend to be moving like you anticipated. Then when it gets here, sharply, it moves back. Then you are taken out. That's very sad. In the same way, this is what happens also, right? This is what the bearish one, thinking the market will move down because this form. Now, the next thing happens, it opens here. It opens here and behave as if what it's actually going to go down. It comes down to this point. The time we realize, within some minutes, boom, it moves up, taking you out. So as you can see, there are two types of this price action pattern. A bullish inside bar false breakout that forms when the market is trending down and is also considered as bullish reversal signal when it is formed near a key support or resistance level, right? A bearish candle, a bearish inside bar false breakout that occurs in a bullish trend and it is seen as a bearish reversal pattern when it is found near an important level in the market, right? This setup can be considered as a continuation pattern if it is traded with the trend. So we are still moving. Inside bars, false breakout, whatever. In my example, in my own experience, the most important levels that traders should look for to trade this signal are the following: support and resistance level, supply and demand zone, right? These are very important. These are the things that you should use as your factors of confluence. So at the end of this book at all, if you are not able to take anything home at the end of this series, at least you should be able to know these factors of confluence. This is very important. You can take a picture of it, you can write it down in your diary and then be using that. It's very important. So we are key support and resistance level, supply and demand areas, Fibonacci retracement, particularly the 50% and 61 retracement levels, the 21 moving averages and trend lines in what? Trending markets, horizontal lines in range bounds market. Here is an example of how to trade the inside bar false breakout in the trending market, right? So this is a general what? Moving down, right? So this is it, right? Price is what? Moving down generally. So when this actually formed initially, right, only these two, you may think the market is going to move up, right? But it doesn't move that way. It just comes down, right? So, in fact, you can even say that you don't even have to overthink. Well, this is a general downtrend, right? And this is what do you call it? An evening star. Taking the 3 into consideration, this is an evening star. And an evening star, what candlestick pattern, we know that it's a bearish type. So when it forms around resistance, this initially it was support. It breaks out, becomes resistance. So if this is a resistance, then we are going to move down. It's as simple as that. Let's look at this example too. Price is what? Moving down generally. This also forms, right? And then looking at only this is what? A bearish, whatever. But when this one forms again, the small black one forming here, it behaves as if the price is going to go up. But in the next minute, realize that price push it back to this level again. I hope you can see the chart clear, right? Here, the 2 is what? The bearish type, right? Bearish army. But on this, the next candlestick pattern forming, it opens as if it's going to be what? Bullish, as in price reversing from here. Let me draw it so you can understand. You see, this is what? Our resistance level. So when it gets here, you may think the price is going to what? Move up because this formed. And the next one is behaving as if it's going to be what? Bullish. The time realize prices, the sellers push the market down again. Then from there, it moves down. So for me, I won't even worry myself using the harami or whatever. I'll just do that. What is forming? What is happening here, right? What is happening? This is a general downtrend. right? A general downtrend, and this harami forming along it. So I'll just wait for it for some time because I'm a conservative trader. Sorry, a minute. Because I'm a conservative trader, I'll wait for it and then enter from around this place. And I go my way. I don't want to even worry myself with the harami, whatever, because with the false breakout, I won't even be concentrating on the false breakout. I'll look at the fact that it's a general downtrend, and then the harami, a bearish harami is forming along that direction. So I'll go in for the sell. It's as simple as that. Right? This is another example. A general downtrend, right? And then I see a bearish harami, right? A bearish harami, looking at only the two here, a bearish harami forming. In this box, the first two candlesticks, it is a bearish harami. And then generally realize that the market is moving up, right? And then it traces to this level, right? When it retraces to this level, I see this bearish harami forming. Before I even consider the whole candlestick, because the whole pattern is what? Actually what? A three candlestick pattern forming what? An evening star. And you know an evening star is a bearish what? Candlestick pattern. So just look at this. Just listen to what I'm saying. Looking at the book and reading from the book as from the book perspective, you might get confused, right? And then yet the book was not written by me, right? That is why I am not trying to make any editing by writing. But at least when I'm teaching you and I'm telling and talking to you, I can make the changes or the editing, my input on the fly. So just listen to what I'm saying. So I am considering the fact that I'm even ignoring the false breakouts that it's talking about. I'm just looking at from the knowledge that I've had already. I've had already that this is what? A general downtrend. And looking at the retracement from this point, it retraces to this what level, the resistance. And then the third thing that I looked at is the two candlestick patterns forming in this box, ignoring the last one. This is a bearish harami, right? And I know that from a bearish harami, when it is formed during an uptrend, then the movement is going to continue. So that is enough for me. And even if I should come again and look at the whole three candlesticks forming that pattern, this is what? An evening star. And an evening star, once again, is a bearish candlestick, right? So when you see it, there's a probability that the trend is going to move downwards. So that is as simple as that. With respect to the resistance level that I've seen here, it's as simple as that. So you look at it with the Fibonacci retracement, right? It's the same as with the engulfing type. So we move this way. We are moving pricing moving generally down, right? Then what forms here? Looking at the three candlestick, this is actually what an evening star. Looking at the three as a whole, but if you look at the two only is what the bearish harami, and this bearish harami is bearish. So price will continue in that general downtrend, right? And then taking the three is an evening star. And then after that, looking at where the retracement happened, it happened around the 50 and 61 Fibonacci levels. So that gives me the signal to actually continue with the sellers. It's as simple as that. If you look here, if I should start from here, right? Let's say I'm ignoring this part, right? And I'm just moving this way, right? So when it gets here, this is what? An uptrend, right? So if it's an uptrend and then looking at the formation here, this candlestick actually is what? Let's see. It's very difficult to identify if it's what. Okay, no problem. Now, looking at the first two candlesticks, this is a bullish what haram. If you remember, check your revision, check your book, your notes. This is what a bullish haram. Looking at only the two, is a bullish haram. And then the bullish haram is happening at what? The bottom level, right? At the support level, I should say, right? And then looking at the Fibonacci retracement tool, this level is around the candlestick pattern of called what? The bullish candlestick pattern, right? So if it's happening around that point, then the market is what? Going to move up, right? It's as simple as that. I don't want to talk too much because we have looked at these things already. So you just have to look at that and then you are good to go. We have another one here forming, right? Another one here forming. And this is what? An evening star with the three candlestick into consideration. Even if you should take the first two, this is what a bearish one. A bearish haram forming at what the resistance level. So price is going to move down. It's as simple as that. So trade examples, right? These are the examples that you can be looking at. So with the trade examples, I think let's do that in another video so that at least it will be convenient for us. Let's do that in another video. So thank you very much for watching. I know you might find it difficult understanding some of this thing, especially at this point, because I didn't want to repeat myself. I think the repetition is too much, right? So you just have to watch from the beginning, and then if you were able to understand that, then I think whatever I did here will be like a revision to you. You don't have to worry your head too much. So thank you very much for watching. Please like and subscribe to our channel. See you in the next episode. Bye.